afternoon and welcome to the last technical webinar before the summer break. Today we will discuss how to build a private equity portfolio in a wealth management context. The speakers will be Elena Cuesta-Oquia, PE specialist at Indosuez Wealth Management, and also Philip Tyson, East Manager at Deloitte, working in the consulting department, which deals with private equity and real estate. A special guest speaker will also be Mathieu Perfetti, the co-chair of our Wealth Management Club. And the presentation will be around the market trends you can find in alternative asset classes, ranging from private equity, also real estate, debt and infrastructure. Next to that, we'll also take an interesting angle of the investors, and they will go through their interest around the allocation, but also timing. For example, also mitigation of portfolio risk, diversification, and certainly the returns. Some special tricks at the end also concerning the choice of your managers. Don't forget to ask your questions. Now is the day, because we have the Q&A or the chat function, and afterwards it will be recorded as usual. So now I will pass over to Mathieu, who will briefly share with you a quick update of his Wealth Management Club. Welcome.
Thank you very much, Stéphane. It's a pleasure to be with you today and for the Wealth Management Club to organize this event. Just a quick introduction about the Wealth Management Club, for which the objective is to demystify, I would say, the private equity asset class, or private market as a whole, as we will discuss about notably real estate infrastructure today, to demystify the private markets across the wealth management sector, which is quite key here in Luxembourg. So the group is meeting on a regular basis, having discussion to see what we can do to build up, first of all, a community, have discussions to demystify this approach. And we are organizing a couple of workshops, webinar, even after works. So if you have any, if you want to join us, please feel free to contact us after this webinar. I leave you with Elena and Philippe. It will be a great discussion about how to build up a private equity portfolio. So thanks, Elena and Philippe, for this presentation.
Many thanks, Stéphane. Many thanks, Mathieu. So I propose you directly dive into the first chapter, which is on looking at the market trends of the alternative asset classes. And if we speak about alternative asset classes today, we mentioned private equity, infrastructure, private debt, and also real estate. At the same time, we'll also look at the portfolio benefits that can be brought by these different asset classes into your wealth management client's portfolio. So let's directly start with the first asset class, being private equity on the next slide. So when looking at the figures of the global private equity markets, we can observe that the annual aggregated capital raised has increased significantly over the 2014 to 2020 period, so by 35%. And this despite the COVID crisis, which nevertheless caused a significant decrease in capital raised between 2019 and 2020, so decreasing by around 14% in 2020 compared to the almost 600 billion in capital raised in 2019. When we look at the market environment that we find ourselves in today, we see that it's characterized by continuing low interest rates, an expected rebound in global growth, and a huge availability of dry powder, which actually all create a favorable environment for private equity funds for the months to come. This is also manifested by the due diligence activity that could be observed globally for the 6 first months of 2021. So deal activity has been as high as not seen before for a long time, which also suggests that a lot of deals that may not have taken place in 2020 and end of 2019 due to the COVID crisis may actually take place in the next months to come. Looking at maybe interesting, however, to go back to what we saw in 2020, also in terms of deals that took place and sectors maybe a bit less impacted by the COVID crisis. Here, especially technology, healthcare, and also financial services stood out as some sort of most looked for industries when we look at private equity deal activity. In these sectors, more than 70% of the global buyout deals were made in 2020. So now let's look at the portfolio benefits brought by private equity investments. First benefit, certainly know by our view is the diversification benefit. We see very low correlation typically between what happens on the public markets and what happens on the private equity markets in terms of returns achieved. Then also we see lower volatility on the private equity markets, which is very much due to the less frequent, very often quarterly asset valuations, which makes that it reduces the portfolio's exposure to short-term market fluctuations. Also, returns have been very interesting, especially in a post-2008 financial crisis environment. And if we speak about private equity investment performance, we can say that over the past 5 years, we observed a 12.5 median annualized net return between 2015 and 2020. And the majority of this return in private equity is due by multiple expansion, but also revenue growth generated by the portfolio companies. Nevertheless, when we look at the environment that we find ourselves in today, it's important to highlight that the deal multiples in Europe, but also the US, are at record levels. So today, general partners have quite strong pressure to generate growth in the companies that they hold in their portfolio, and which makes it also for fund managers ever more important to have deep subsector knowledge in order to make sure to position in the right portfolio companies. The last element I would like to mention here for private equity, which also makes it an interesting asset class, is that lead investors, so be it investors, private clients who can take a significant stake in portfolio companies, or the fund managers behind, can actively participate in driving the company's strategic growth and management, and thereby themselves become involved in value creation. So now we turn towards real estate. Real estate, that is with 916 billion of assets under management in June 2020, the second largest alternative asset class, which has, however, been particularly hit by the COVID crisis, and we see it here on the graph. While in 2019, capital raised was still at 135 billion, it decreased by more than 25% in 2020. In a similar fashion, the deal volume has dropped significantly, even stronger, by 39%. Here, a clear driver of this decrease in deals was the fact that due to the market uncertainty, but also the lockdowns, it was very difficult to have physical meetings and for managers to do due diligence, to have due diligence discussions, which made it very difficult to get deals closed. However, worth mentioning that there were differences from a geographical perspective. So in the Asia-Pacific zone, the real estate sector did pretty well and stood out from other regions. One reason for that was that the performance was mainly driven by the fact that local investors were constrained to invest locally because of the travel restrictions, but also the fast recovery of China from the pandemic. Looking now at portfolio benefits from real estate, again, we see this diversification benefit, even a stronger uncorrelation between real estate market and public markets, which can even be negative in some scenarios. Particular to real estate is the steady income that is generated and consistent cash flows received by the investors, which is backed by tenant rent payments. Also linked to the payment of rents, as rents are typically linked to inflation. So in case there is significant inflation in the market, this also drives up rent and thereby the cash flow received by investors. A last element interesting for the real estate sector is the tax efficiency it can generate. This, of course, dependent on country requirements, but the depreciation that you can have on real estate assets reduces the portion of taxable income and can as such act as a tax shield. Now coming to the third largest alternative asset class, which is almost at the same level than what we can see and observe on the real estate market, is private debt. So here, same as in the real estate sector, we observed 99 billion of capital raised in 2020, and also assets under management are at levels very close to the real estate market. So with 887 billion of assets under management in June 2020. Also very interesting to see is that private debt is the only asset class which did pretty well and which was able to raise more capital in 2020 than it did in 2019. Sorry. However, investors also lacked investment opportunities, which drove up dry powder by 19% on a year-over-year basis. The reasons why also here deal activity didn't went as expected was a bit due to the government's packages which supported companies in refinancing needs. However, as we have today growing uncertainty on how the governments may back the companies in the months and years to come, and which also depends on the future evolution of the COVID crisis, there may be a higher reliance on private debt for refinancing purposes. Now coming at how private debt investments are interesting for wealth management client portfolios. One particularity for private debt is clearly the shorter investment duration. Private debt investments, contrary to what we see in private equity or even infrastructure, where we can have fund terms of 10 years or even more, in private debt, this is shorter, and we very often see fund terms of 5 to 6 years, which may be interesting for some investors who do not want to see their money locked up for so long periods of time. Then very similar to what is observed in real estate, also in private debt, we have more consistent cash flows which are generated from the interest payments and the loan repayments, which lead to steady investment income for the private clients. And also here we have private debt investments, which are structured investments with preset repayment terms, which clearly reduces the volatility of the asset valuations. Finally, we turn towards the smallest alternative asset class with 550 billion of global assets under management as of June 2020, and 84 billion of capital raised in that same year. However, and you see it on the graph, the growth of this asset class is huge. So we only had 42 billion of capital raised in 2014, which, as I said before, increased to 84 billion in 2020. And here a clear growth driver also comes from ESG considerations, which have a huge impact on the deals being made and also drive investments towards renewable energies. Looking at the benefits brought by infrastructure investments, diversification here is very interesting also from a different perspective, and by the fact that by investing into infrastructure, investors get access to assets which they typically could not get when investing on the public markets. So different type of asset that can be included into a private client's portfolio. Then in infrastructure, we also see consistent valuations. This is very much linked to the nature of the assets, but also the infrequency of asset valuations. So when private equity, we typically see the quarterly asset valuations. In infrastructure, this can go down to only annual or semi-annual valuations. And the last element I want to mention is the steady income. So with infrastructure assets, they provide essential services, which makes demand and investment returns pretty stable. So now we have gone through the overview and recent market trends of alternative asset classes, and now in the second chapter, Elena will elaborate on the questions investors need to address when building a private equity portfolio.
Thank you, Philippe, for the introduction. So yeah, as mentioned by Philippe, the long-term outperformance of private markets versus public markets, as well as the increasing appetite for alpha, has driven new investors to try to enter private markets, as well as existing investors to try to expand or increase their allocation to private markets, resulting in an increased fundraising. We are also seeing quite a lot of democratization of the asset class, which was historically more reserved to institutional investors, and today, and for a few years, we have seen how it opens its doors to the wider audience, including, of course, high net worth individuals. And this process has pushed private equity or private markets more in general to become a core asset class in private banking allocations. Investors looking to go into private markets are looking to achieve attractive returns, of course, but also to limit their downside risk. And a key factor in their success is building a well-diversified and a well-constructed portfolio, which is aligned with their investment goals and restrictions. This might sound straightforward, but it actually is not. It is actually anything but. Building and maintaining a well-diversified private markets portfolio is a dynamic and complex process, and it requires specialized technical and investment expertise, as well as a strong legal, compliance, operational, and accounting system. And Suez has worked for over 20 years in building private markets portfolios for high net worth individuals. And during these years, we have understood that the first step to building a private markets portfolio is finding the answer to these 6 questions. And that's only the start of this complex process. So if we start with the first question, this would be how much to invest in private equity or private markets. Of course, the answer to this question depends on the investor's characteristics, so the risk appetite, the objectives in terms of time horizon, the liquidity of his overall portfolio. And Philip will go a bit more in detail through that at the end of the presentation. But if we had to give a ballpark figure, we would say we recommend between 5 and 20% of overall wealth to be invested in private markets. And this actually coincides exactly with what we see in the more overall market in terms of institutional investors. One thing that it is important actually to take into account when working towards reaching that 5 to 20% allocation is that actually the amount that we commit in a private equity fund is not the amount that will actually be invested, or there is a difference between commitments and actual cash at work. As many of you know, unlike other investments, when an investor commits to a private equity fund, the full amount of the commitment will not be called straight away. The capital calls will happen over a certain period, usually 4 to 5 years, which is the investment period. And similarly, once the fund exits investments, the investor will start receiving distributions. And often those distributions come before the end of the investment period, which means that actually in a net basis, the client or investor will not reach the full commitment called at any point. So this is very important, and this curve is very important to keep in mind when building a private markets portfolio, especially as performance is actually calculated on the amount of cash that is working and not on the commitment. So in general, you can keep in mind the rule target between 5 and 20%, depending on the investor's characteristic, but with 3 things to keep in mind. Commitments are not cash at work. Commitments will be called over time, so the full exposure will not be reached right away. And finally, no reinvestments means that you will slowly lose exposure to the asset class. So when you finally think that you are there in your target, if you haven't reinvested, you will actually start losing exposure to the asset class. So these are the three things to take into account when working towards reaching your target allocation to private markets. The second question is one that, as you can imagine, we are getting a lot, especially in the last few months. In the current environment, as described by Philippe, we are seeing quite a lot of fundraising, high valuations overall, especially in certain sectors. So we get asked a lot, well, is this the right timing to invest, or when will be the right timing to enter the asset class? And while market cycles are easy to identify in hindsight, it's quite difficult, if not impossible, to actually predict cycles. So this is true everywhere, but especially in private markets where the funds, as we say, have the aim of taking or making investments during a period of 5 years, with the life of the fund actually being more around 10 years. So it could be that the start of an investment period is before a recession and the end is after a recession. And similarly, it can be that this investment period or the companies are sold in completely different phases of the business cycle. And actually, Harbor Vest, which is a big player in the private markets world, made a very interesting study recently. What they did is they took all of the commitments that they had made from 1992 to 2011. And they actually made the exercise of saying, okay, what would have happened if I take away the worst 3 vintages? And what happens if I take away the best 3 vintages? And actually they found that the added value of excluding the worst 3 vintages, so actually guessing market timing and managing to guess which ones would be the worst, the upside from that is much smaller. It's actually half of the upside of the upside from that is actually half of the added value of the risk of missing the best 3 vintages. So what they actually say is making allocation over multiple vintages, irrespective of the state of the market, without trying to guess market timing, is actually a way to improve risk-adjusted returns. It's almost, as I said, impossible to determine which vintages will perform best. So a consistent allocation minimizes the risk of missing the best 3 vintages. Another question that it's important to ask, and this ties really well with what Philip was explaining about the best or the advantages of each of the sub-asset classes in private markets, is how to mitigate the risk of capital losses. And here, unlike the previous question, the answer is actually quite simple. So the answer is just diversify. For most investors, one of the key objectives of investing in private equity on top of generating returns is reducing risk by decreasing correlation to listed markets. And we have actually found that data shows that every layer of diversification that we can add to a private markets portfolio results in reducing this correlation further and actually improving risk-adjusted returns. Here you have the median net IRRs by fund type and vintage year for different asset classes. So we have here private equity, private debt, and real estate. And you see this data clearly highlights that it's nearly impossible to pick a single and a consistently winning strategy. And it highlights as well the risk of a sudden or trying to perform a short-term exit from a given market segment. So what we recommend, again, is that investors should allocate to a diversified set of asset classes every year or every 2 years. And the weight of each of these asset classes can be made depending on the investor preferences. So this takes us back to what Philip said. So in terms of duration, in terms of a recurrence of cash flow, etc. Similarly, geographic diversification is also extremely important in improving risk-adjusted returns. Adding global exposure obviously improves downside risk protection, as global markets are not perfectly correlated, as you see in the graph. While bringing this diversification to portfolio, investors might be tempted to try to make quick tactile tilts to adjust to changing dynamics in the market. But again, there are real limitations to these tactical movements because it actually takes time to put in place, to execute, and to build value within a specific private market strategy. Continuing on the topic of diversification, this time we talk about the number of funds that are necessary to build a well-diversified private markets portfolio. Obviously, diversifying across managers and across different funds helps reduce idiosyncratic risk or manager-specific risk. So it is important. We actually, analyzing data, we found that to achieve a higher probability of a certain IRR, the best is to have at least 15 funds in portfolio. So, of course, diversification is important, but it's also key to take into account your investors' monitoring capabilities. In the process of increasing allocation to private markets, often investors, and this can be private investors, but also we see it with institutional investors, they increase allocation and they start working with a large number of managers or funds, and actually more than that they can effectively monitor. And this is important because it can lead to an overly diversified portfolio with little investment control, low transparency, and in the end, the inability to build productive relations with general partners, which is also very, very important. Next question is also an interesting one. So how do I optimize portfolio returns? And this is a bit linked with portfolio diversification as well. Complementing primary fund commitments with co-investments and secondary fund commitments actually increases diversification, and it can increase also cash flow consistency, which, as we saw at the beginning, is extremely important. Co-investments, meaning investing directly into companies with private equity managers, can help lower costs. It can help shorten the J-curve, as usually there is a higher rate of investment, a higher rhythm. You can invest faster when you co-invest, and also they can help generate alpha via a more concentrated approach, albeit, of course, with increased investment risk. Secondary investments are also quite complementary to a diversified private markets portfolio. They can generate earlier appreciation, reduce the J-curve, and they are also associated with earlier distributions, so further liquidity in the portfolio, which is extremely important. They also add backwards time diversification, which can be quite useful, especially for investors that are only starting their private markets portfolio. And finally, we reached the last question, which is also extremely important. If we had to highlight 2 of the 6, I would say the first and the last are the most important ones. And this, well, Philippe went through the fundraising trends before. We saw that we are actually reaching really high figures in terms of fundraising, record-breaking figures. In the second quarter of 2021, on its own, private capital funds raised $300 billion. So again, a record broken. And this might continue in the coming quarters, as there is actually a very good momentum on exits at the moment. So this means some investors will receive distributions and will want to commit more to private markets in order to maintain their level of allocation. So fundraising is rising, but what about the number of funds? And what's interesting to see is while the figures in terms of aggregate capital raised keep rising, the number of funds is reducing, it's decreasing. And this is due to an increasing concentration on a certain private equity managers. And actually, what is quite impressive is that in Q2 2021, 2/3 of the capital raised were raised by only 6 partnerships. All of them above $10 billion. So this is quite impressive. Makes the selection slightly easier because the universe of funds from which we can choose is smaller, but it still means that we have over 1,000 funds raising capital in a single year. So a lot of choices, and actually making the right choice can be what defines the final performance of the portfolio. What is interesting to see as well is that actually with this concentration in some managers comes more difficulty in terms of access, especially in the mid-market segment, where usually private equity managers do not want to increase their fund size too much because they have to invest it afterwards. So if they have too much capital, it might create an issue then in terms of deployment. So we have a lot of oversubscribed funds, especially in the mid-market segment, which actually pushes investors to go towards larger cap funds and increases concentration. So it's a bit of a vicious cycle, but access is definitely something to take into account, and increasingly so in private markets. So we have a universe of more than 1,000 funds, and how do we choose the best ones, or how do we choose with whom to invest? Of course, we have to exclude the ones that we might not have access to, but if we could access all of the universe of funds, selection is key, and it's quite a complex exercise. So analyzing the track record is not enough. As you see in this graph, having a previous first quartile fund does not mean that you will have a first quartile fund again. Manager selection requires a high degree of due diligence expertise in order to evaluate the fund, the strategy, the structure, and the capacity of the team to generate consistent returns, which is the most important. We are in an environment where the tide seems to be lifting all boats, and so complacency in this environment is extremely dangerous. Generating returns does require vigilance. It requires proven selection skills and access to top quality managers. There is a big difference between returns from high quality managers and worst performing managers. And also in an environment of high valuations, this is even more important because they leave little room for multiple appreciation, as Philippe said before. Deleveraging is also playing a small role today in generating returns. So value creation relies entirely on strategic and operational engineering. And so selecting the best managers to do that is essential to creating a good private markets portfolio. So rigorous due diligence, experience, skills, as well as access, once again, are key to build a good diversified private markets portfolio. So in summary, a bit of a summary of everything that we have mentioned during this presentation. Be overcommitted. So take into account that the amount that you commit will not be fully invested. So target a bit more than your actual target is. Take your time to take your commitments. Don't try to time the market. It's better to take commitments over a series of different vintages. So we would say minimum 3 different vintages. Go deep, try to reach at least 15 funds to have 150 companies and try to ensure to reach a certain level of IRR. Diversify by strategies. The slides that Philippe presented in the beginning can be quite useful for that, but also in terms of sectors and in terms of geographies, of course. Also, how to reduce the portfolio risk and optimize returns overall. It's important to integrate, of course, fund commitments, but also co-investments and secondaries. And this is also a useful way to actually manage your cash flows. And again, this comes back to the overcommitment issues. And finally, be selective. And if you need help on choosing your partners, find a good advisor that can help you identify who are the best managers to invest with.
Thank you, Elena. Thank you, Elena, for presenting the different facets of private equity portfolio construction. To conclude this presentation, we would, however, like to highlight that it's at the end the investor, the client, or the investor cluster that you want to target, which is at the center of portfolio construction. So we highlighted a few, not all, of the different facets that need to be considered when building the portfolio and going through the different elements that Elena just highlighted. So the first one is really to understand who is my investor. How old is he? What is the wealth that he has on a global scale? Where does this wealth come from? Which all drive and impact the risk appetite, the tolerance for risk, but also the return that person or this type of persons may look for. The second element, and we discussed it already today, is the investment horizon, very much linked to also the liquidity need of the investor. So by when does my client actually needs to have his money back, which impacts, of course, the fund, the product term I'm selecting, I'm building, but also the liquidity mechanisms I may be looking for in the product I propose for my client. Then the third element, which is important as well, is to very well understand the appetite, but also the tolerance for the investor to take risk, and also his expectations, his ambitions in terms of return, which all drive the selection of the right investment strategy, the risk he wants to take, and so also the assets, the underlying assets and funds that may be appropriate. Then, as a last element, there may be, depending on client preferences, also a preference for different types of products. So here we can think about being invested into a feeder fund, so where a client directly gets an exposure maybe to top leading managers, private equity fund, so fund with a good reputation and known manager. On the other side, there may be clients who have a preference for well-diversified fund-of-fund vehicles, where via 2-3 products, they can have a well-diversified private equity portfolio, being exposed to different geographies, different sectors, via a limited number of products. Then others may have a preference for direct funds, so direct funds with concrete asset allocation, good visibility on holding companies, and where the investors can actually follow the evolution and the growth of the companies they are committed in and in which they put their money. So we have now actually covered the core of our presentation today. Many thanks for your attention and participation to the workshop today. And I would propose we go over to the round of questions and answers. And I actually see that we have already the first one in the chat. I quickly go through it. It's a question, I think, Elena, on the section on timing investments and the relevance on finding the right moment and making sure that the right vintages of funds are included in a wealth management client's portfolio.
Regarding, I imagine, the J curve and the timing of capital calls, I imagine the question is relating to that. So, of course, the capital calls are made by the private equity managers, so we have no control over that. We can try to predict when these capital calls will happen, and this is part of the work that we do at Andosias with our clients, trying to predict how the cash flows are going to happen in the coming years, to try to ease the cash flow, the management of the client's cash and liquidity. But it's also something that we have to take into account when determining how much we want to commit, depending on how much we want to actually invest. So this was a bit the meaning of my slide. If we want to reach an exposure to the asset class of, for example, 2 million, you will have to commit a bit more, so 3 million, because otherwise you will never reach that amount actually invested. And also you will need to take more commitments over time if you don't want to lose your exposure. I think that's what you need to take out from this slide.
This is Lori. I'm based in the New York area. I'm not sure that we're supposed to talk. But you know what? I thought of something else. I knew how the private equities investment are made. It just doesn't. I thought this panel was about how you help your wealth management clients to put together investments in these areas. And if you're talking about 2 million. Are you really talking about in a $1 billion portfolio? I'm not sure this is we're on the same page, right? Because you cannot ask for somebody who put all of their portfolio in private equity investments or the like. I know all about private equity investments. I guess that was what I was trying to say. And this talks about your capital call, your diversification. It seems to me that you're addressing the audience of LPs. Am I not getting something?
I mean, in a way, the private investors, the private banking clients will be LPs to these funds. So yes, in a way, obviously for smaller amounts. And that's why Philip then talked about feeders or a fund of fund structure. But the way they work is similar to normal private equity funds usually. So this is applicable at any. I mean, we can talk about smaller or bigger amounts, but in the end, the way that you have to think about portfolio construction is similar as if you were a normal LP.
No, I'm not sure, Elena, but we can leave for the time being for this discussion. I think LPs have much bigger amounts to commit in general.
Yes, of course, but that's why private banks have to make vehicles that make these funds accessible to their clients through smaller amounts, but the principles are the same.
Sure, if you were talking about raising the capital pool from the wealth management area, yes.
But if not, thanks a lot, Elena and Philip, for this very practical session, for this great overview. I think you already have in mind to pursue those series of webinars with this Wealth Management Club of the LPA and also with Mathieu. Dear audience, thanks for joining us today. The recording will be available soon to the LPA members as usual. And since that was our last event before the summer break, we wanted to wish you some great holidays. Take good care of yourself and your family, stay safe, and let's catch up soon in Q4 with lots of new projects, and certainly also the LPA Insights Conference in October around technology and disruption. It was a great pleasure to have you here. And next week, you will also still be able to get our newsletter with the last Carrot Weekly episode, which is the synopsis of our different activities. So we wanted to thank you again and say goodbye.